So good afternoon, everyone. Myself Anjali Nair on behalf of Kirin Advisors. It's a pleasure to welcome you all to the Beyond the Numbers Value Discovery Summit 2025, powered by Value Educator, co-powered by Kirin Advisors. Today marks the final day of our 3-day summit, featuring a powerful lineup of focused management meetings to conclude the journey on a high note. We proceed to the fourth interaction of the day with NIS Management Limited. From the management team, we have with us Mr. Debajit Chaudhary, the Managing Director. Welcome, sir. Good afternoon.
Good afternoon.
And we have Mr. Kanad Mukherjee, the CFO. Welcome, sir. Good afternoon.
Thank you. Thank you. Good afternoon.
From the Value Educator team, we have with us Mr. Sahil. With that, now I hand over the floor to Mr. Sahil. Over to you.
Before we begin, there is a brief introduction about the company. Incorporated in 1985, NIS Management has evolved into a multi-service platform offering security services, facility management, electronic surveillance solution, and skill development program. The company today deploys over 17,200 1,300 spans man garden integrated facility management, housekeeping, CCTV, electronic security management, training-led skill services. NIS works corporate banks, industrial units, hospitality, healthcare, retail groups, and several government bodies. The company is increasing its prioritizing higher margin tech-enabled verticals, particularly integrated facility management and CCTV installation. Rental reflecting a strategic shift towards scalable value accelerative services. Now, open the question answer session, sir.
Okay. Do I need to give an introduction, a further introduction to the to what Mr. Sahil said, or?
Yes, sir. Please give a short introduction.
Okay, right. A very good afternoon to everyone, and I would like to give you an introduction in a little more detail, which means that you see, we have as an organization started our journey in 1985, and which was at that time purely a security guarding and a private investigation organization. But in 2006, we actually incorporated the business in the name of NIS Management Limited. And by that time, we have already had in our portfolio the security guarding business, we had facility management business, we had electronic security business, and we also started at that time a very nascent skill development initiative. We have a pretty large workforce of about 17,000 boys and girls, and we operate in 14 states of India. And we manage this entire workforce of 17,000 over 1,300 sites, and we manage it with a very lean team of 125 persons spread across our different offices, the head office or the corporate office and the branch offices. And as Mr. Sahil has already said, that we have among our clients corporate banks, hospitality groups. In fact, if you look at our 40 years of experience, then there would be very, very few facility verticals in which we have not provided our services. And we also provide our services extensively to the public sector units and the government departments. We also operate two other firms. One is the NIS Facility Management Services Private Limited, and the Kirtika Academy Private Limited. The NIS Facility Management Services Private Limited basically deals with the electronic security that we work as an SI partner. And in Kirtika Academy, we do the skill development as a NSDC partner. and we have already trained more than 1.5 lakhs of boys and girls. From financial perspective, the first half of 2026 has been encouraging for us. And I would just share a few numbers for a ready economy. And our total income in this period was 214.89 crores, and that reflect a year-on-year growth of 6.8%. Our EBITDA improved from 16.73 crores, representing a growth of 11.31%, and our EBITDA margin expanded to 7.79%. This was an improvement of about 32 basis points. Our EBITDA margin expanded, and our PAT increased to 10.22 crores, which was a growth of 12.57% on a year-on-year basis. And our PAT margin improved by 24 basis points to reach 4.76%. At a standalone level, our total income, standalone level at NIS Management Private Limited, our total income, NIS Management Limited, our total income for H1 FY26 was 204.69 crore, an increase of 8.36% year on year. And our standalone EBITDA grew strongly to 13.95 crore, reflecting a growth of 28.87%. EBITDA margin improved by 108 basis points to reach 6.81%. Our PAT increased significantly to 9.12 crores, which is a growth of 40.07% year on year, and PAT margin expanded by 101 basis points to reach 4.46%. EPS stood at 5.73, a year on year increase of 32.03%. Going forward, we are concentrating our efforts in integrated facility management so that our individual verticals of security, guarding, housekeeping services, electronic security services, other hard services in facilities management, etc., we can combine all together and provide integrated services, which we expect to help us give a much higher margin in our business. And with the government of India continuing to increase spending on infrastructure, we see a very strong pipeline of tenders coming in the integrated facility management area. And we are also going to have a substantial growth in the private sector towards integrated facility management. Alongside this integrated facilities management, we are also exclusively focusing on our CCTV business, and we hope to expand our CCTV business again, driven quite extensively by government requirements that are happening in different public sector units and also in different city level surveillance and security needs. And we expect that with the facility management system business and the CCTV business working together, we shall have a very substantial growth in the coming days. We are having a steady client onboarding this year, and more corporates are recognizing the value of specialized facility management services, as I said, instead of the informal cleaning and basic maintenance arrangements that are still very regular in most establishments. The shift supports our business model and allows us to provide higher value services that improve margins. As a geographical expansion, we are already operating from 14 branches, and some of these branches are where we have extensive footprints, but some of the branches are also nascent, and we are looking at expanding aggressively in the nascent branches, especially looking at Maharashtra and Gujarat, where we are already seeing a very brisk growth rate. And I would also like to put in that the organized facility management sector, as I said, is experiencing a very strong momentum, and so also the CCTV sector. And these two should act as our tailwinds in our future growth. I would like to leave it here and invite questions on our organization.
Thank you, sir. So participants, the floor is now open for Q&A. Kindly raise your hand or you can drop your questions in the chat box. So we have some questions in the chat box. So we have first question from Miss Divya. She is asking what are the margin and DSO differences between government and private IFM contracts?
Okay, I think Kanad, our CFO, is present here, and he would be the right person to answer this.
Yeah, so thank you for your question. The first thing is that in terms of DSO, the government contracts are, typically they have a DSO of around 3.5 to 4 months, depending on the size. Now, IFM contracts typically are big contracts in terms of monthly volume. So we have, let's say, a contract called in Bihar under from Krishi Bhavan, which is the agricultural ministry, and that is 60 lakh billing per month. Now, in that contract, we've had a DSO of around 3 months, and we have a margin there of roughly 13%. Now, this is just one example. Overall, we see that government gives us the size, but it does come with a higher DSO, which kind of, and therefore the DSO and the margin typically offset each other. Typically, in the private sector, there are fewer contracts which are under the IFM, and we see typically we have the schools under we have Birla schools under which are managed by us under the IFM contract, and they have a DSO of 2 months, and they typically have around 8 to 9% in terms of service charge. So these are just two examples that I've given to kind of showcase the difference in terms of DSO and margin. So I hope that I've been able to answer that question.
Thank you, sir. So we have next question from Ms. Divya. She's asking, what is the targeted state-wise revenue mixed by FY27 to reduce West Bengal's 77% contribution?
We do not typically make very state-wise targets because of one particular reason that you see, we participate a lot in tenders, and it is very difficult to really project the quantum of tenders suitable for us that would be coming up in the next quarter or in the next 2 quarters. So it becomes very difficult to really project the target numbers. And there is also another issue that even if there are contracts, oftentimes in the tender section where we would have participated already, and the awarding of the tender time is very difficult to predict because it sometimes happens within the next 2 months, or it may even take more than 6 7 months. So that is specifically state-wise, segment-wise tender. A prediction of acquisition of contracts becomes slightly difficult, and this is also true in the private sector in other areas. Like we have very large contracts with, say, Reliance, and there are Spencers and others, HDFC. With these clients of ours, there is a continuous expansion which happens in their different branches or in their different retail outlets as far as Reliance is concerned. And it is very difficult to really assess that where is the next burst of growth is about to come from in a state-wise segregation. But we would like to tell you that we have an approximately about a plan of increasing our footprints outside the East by at least about 10% over the next 1 year or so. But this is a very open number, but this is the target that we are keeping right now.
Thank you, sir. So we have next question from Mr. Pranay. He's asking how much of the guided 7.5 to 8 percentage
Ma'am, I think that has been answered.
Okay, sir.
Oh, no, 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 no. Sorry, sorry, sorry. My
Okay.
mistake. Please carry on.
Yeah. So how much of the guided 7.5 to 8 percentage EBITDA margin improvement is due to pricing power versus mix shift, and how resilient is it to faster wage inflation?
Faster wage
Inflation.
inflation. Okay, I'll give you over a broad number, broad details, and after that, if there are any details on the figures, etc., which can be added, then Kanad will do that. Well, the first thing is that the pricing inflation has been rather static in our case, and we don't see. What happens typically is that with the inflation, then there is a revision in the minimum wages in contracts, and this revision in the minimum wages affect our total growth. And traditionally, this number has been staying at less than 5%. Okay, so I think going this year also, we are not going to see a significant difference of this. In particular states, there may be certain differences because, the West Bengal is going to into an election year, and in such cases, there are state-specific revisions in the minimum wages at times. But overall, we don't see much of a very significant change in that. And the other is achieving the EBITDA will depend on our ability to actually increase the product mix, which will be more substantial, we hope. And if we can actually shift add to our contracts, we actually, in this process, what we are doing is we are trying to add facility management contracts and CCTV contracts to our total portfolio. It's not that we will be shedding out any low margin contracts. So we will see a bit of an improvement in that area. And I think going forward, it should be giving us a higher percentage of EBITDA margins than the inflation part.
Thank you, sir. So we have a next question in the chat box. For a security only client converted to IFM, what is the typical revenue uplift and margin improvement per site and break-even timeline?
It happens over a particular period. You see, traditionally, what happens is that we have a pure security contract, and then over time we add facility services, soft facility services like housekeeping, horticulture, etc., into the portfolio of the contract. And then over another period of time, then we move into the hard services area like electromechanical and all. Traditionally, the migration from pure security to soft services or addition of soft services to pure security happens early. It happens I think, immediately after the trust is built in the contract with the customers. So that happens around, say, a period of 2 years. And then the hard services do take a little longer period. And it actually happens that a pure security guard contract evolves into a full-fledged facility management contract over a period of 3 to 4 years. But it is far more easier to actually acquire a full IFM contract than actually migrating only traditional security one to a full IFM contract. But since we are an organization which is working in this field for the last so many years, so now both of these happen together. And there is also another element I would like to put in, that there is also a very good prospect, which we also capitalized at some extent, where our security guarding contract actually add the provision of electronic security in there, and thus boosting the margin again. So that also happens, that a certain core security guarding contracts evolve into a comprehensive security contract, including CCTV, which also boosts margin.
Thank you, sir. So we have next question from Mr. Pranay. He's asking what prevents rental CCTV from scaling beyond the
Sorry, ma'am,
target?
I think you missed one.
Yeah, so sir.
Is the AI analytics layer
Is the AI analytics layer proprietary or partner-led? And how does it protect pricing as CCTV hardware commodities?
Okay.
commoditizes? So, which means, I think the primary question is that if there is a hardware commoditization that's happening across the CCTV industry, then how does our AI analytics help to offset that commoditization?
I would like to answer it this way, that the entire analytics that happens on the AI front in our organization, and also some of our partner organizations in CCTV, like there's a company called SatSafety and there is Videonetics, etc. In their cases, in these companies' cases, the entire AI analytics that they do are proprietary, and we also have our own proprietary systems in AI analytics in different activities. Although we do not attach the AI analytics to the computer vision element yet. So for most cases, our application of AI is a proprietary application, although the algorithms, everything are oftentimes taken from different galleries as available or different platforms as available in the software world.
Thank you, sir. So we have next question from Mr. Pranay. He is asking what prevents rental CCTV from scaling beyond the targeted 40% of CCTV revenue, capital, client preference, or execution capacity?
The main challenge in getting rental contract are two. First is, of course, getting this contract. You see, there is always a preference as yet for most traditional customers to have procured their own CCTV effectively, devices and other networks and capitalize the cost. So when that happens, then the customer is getting certain benefits of depreciation, etc. And so they often desire to have the installations or systems integration done through a CapEx model. There are customers who are gradually increasing, are preferring to move towards the OpEx model. The two very important drivers in these elements is, number one, there are customers, including public sector customers, who are not willing to spend upfront for the entire device cost or the hardware cost, primarily because the obsolescence factor in hardwares and devices. And for that reason, customers are now coming up for options where we can give them options of rental, and where we maintain the camera ourselves, and if whenever necessary we do the changing, and whatever upgradation is required for the devices and the hardware networks, etc., we can keep doing that throughout. So that is one aspect of it. And then there is another aspect for which the customers are also opting for these kind of things, because as we more and more we move into AI driven, analytics driven CCTV installations, these require continuous monitoring and upgradations. So the whenever new analytics come, or managing these analytics, etc., these are specialist works and which require participation of the OEMs, and therefore the customer, even if would prefer otherwise to have a fixed asset in their name, but maintaining the intelligence status or the smartness of these devices and systems would require a constant upgradation, and which would not be possible for them until and unless it is on an OpEx model that is being offered. So for these two primary reasons, their customers are gradually moving towards this. But against this, there is also another small headwind, although we have not faced it as yet, but there is a potential headwind which we have to remain prepared for when we are scaling up. And that is that even if we have a 4-year, 5-year contract, even with the government, there are certain risks of a few of those contracts may actually turning weak after say 3 or 4 years because of the change in the management or change in the government and things like that, for which we are also right now keeping our options of going for an extensive rental model or to on a testing level instead of a full-fledged offer level.
Thank you, sir. So we have next question from Mr. Vritesh Nair. He's asking, how do you ensure compliance with labor laws, PF, ESIC, and statutory regulations across states?
Well, we are a 40-year-old organization, and we are working in multiple states from the very beginning. In fact, we started, although we have had our office in West Bengal from the very first day, Calcutta, but our first contracts had all come from multiple states. But it is a fact that over the year, the compliance issues have become more and more stringent than what it was earlier. And while this was happening, there were two things which we started working on. One is developing our own ERP. The ERP that we have developed since 2006 basically was focused on the entire payroll structure of the personnel and the recruitment structure of the security and facility housekeeping personnel that we were deploying. Because of this ERP system, we can today, in spite of having 1,300 sites over 14 locations, we can track down the compliance status for every single site, for every single individual. And we are managing this rather effectively over all these years. And there has been very, very few complaints which we have not been able to attend or which has very difficult implications, and that has happened because we were not aware or the data was not available.
Okay, thank you, sir. So we have next question. Have there been any instance of penalties, disputes, or delayed receivables due to compliance issues?
Well, if you look at our 40 years background, then you see when we are managing a labor business of about 17,000, then what happens is that occasionally certain penalties do come about, and most of the penalties usually come about from our customers themselves, because say in case there is a wage delay of a day or two and the customer is not happy, then usually our SLAs cover for those, and so there have been those penalties, etc. And also, in certain cases, there have been certain claims in the labor element, which usually remain restricted to labor departments and such other places, and where on the basis of conciliations or hearings that happen, there are certain penalties of nominal nature. Penalties do happen, but very rarely these are, in fact, in our history, penalties have not yet become a debilitating factor in our conducting the business.
Thank you, sir. So next question is, what internal controls are in place to mitigate operational and regulatory risk?
First is, as I mentioned, we have a pretty developed and sophisticated ERP today addressing labor compliances and operational compliances. Also, we also have a system of monitoring our SLA. We have our own audit system, and usually for the large contracts, our customers also have their own audit system to which we respond proactively and collectively with our customers. We maintain an audit environment in which there is continuous audit to identify if there are lapses which are happening, and those can be mitigated. We have done that successfully over the 40 years in addressing these issues, and we have a very detailed structure within our ERP which also tracks down non-compliances, either in the
Just to be
statutory area or in the commercial area. I think
yeah,
Kanad has something to say.
just to be a little more specific on that and add to that, whenever we get a new client, we have something called a notice checklist. which essentially means that what are the compliances that we have to do moving on when we as we take on board the client and we start the operations there. And considering that we are in a heavily regulated industry where you have wage and provident fund, ESIC, GST, they take up lion's share of our expenses and cash flows. We typically are, that motive checklist serves as one of our strongest internal control measures. Which means that we have to make the wage payment by, let's say, 7th or 8th of the month, and then we have to submit the details of wage payment to the clients. The moment there is a delay at that level, then it gets highlighted at the ERP level, and immediately corrections are taken. The provident fund ESIC has to be paid before the 15th of the month, so that becomes another checkpoint. Then GST has to be paid by the 20th of the month, so that becomes another checkpoint. And these are larger, these form the lion's share of the entire cash flow. So this is how we ensure that on a month-on-month basis we adhere to the OTIF checklists. Wherever there are variances, it gets highlighted at the ERP level, and which ultimately get reported to the CMD, and then corrective actions are taken in the subsequent months.
Thank you, sir. So we have next question from Ms. Rasika. She's asking, who do you see as your primary competitors, organized national players or regional firms?
Well, it is a very, very interesting question. You see, very frankly, it is so easy to identify our organized competitors, and therefore it is so easy to name them. Whereas our unorganized competitors are real big. If you would look at it, then possibly the informal sector in the security and the facility management space comprises of about more than 80% of the total business structure. Maybe revenue-wise, it would be a little less, maybe about 50-60%. So identifying a competitor from the informal sector is extremely difficult. So anybody who actually can go escape the radar and quote and operate at rates which are less than, say, statutorily required for payment of wages or provident fund, ESI bonus, etc. They are all our competitors. Our organized competitors, they're big, they're extremely good players, but it is also true that we know our competitors very well in those sectors. And since we are pretty old players in this industry, so we happen to be in almost uh, in talking terms with every one of our organized competitors. I think going forward, the real challenge for us in the business is to have the informal competitors to come in the formal fold.
Thank you, sir. So we have next question from Mr. Viraj. He's asking, what is the typical onboarding time from contract award to full-scale deployment?
I would say that depends on the size of the contract. There are many contracts where we deploy even at a less than days notice, since we are into security, and security also form some sort of an essential service. So oftentimes our requests come from clients where we have to deploy almost immediately, and where we have to actually ramp up our full deployment within the next few hours or even the next day or two. But typically for a contract of a significant size, which is usually more than, say, 25, 50 or so, we prefer to have a 1 month's notice period so that we have sufficient time for training of the newly inducted personnel. Otherwise, at least 15 days. So I would say, depending on whether it is a public sector contract or a private sector one, it usually varies between 1 month and 7 to 10 days.
Thank you, sir. So next question is, do you track an order book or contract pipeline, and what is the current visibility for the next 12 to 18 months?
Kanad, will you be able to answer that?
Yeah, we typically we have an annuity kind of a business, and which means that typically when we get a customer, the customer rolls over on a year-on-year basis, and we have a retention ratio of around 5.5 years. Um, so when we say order book, one of the points is retention. How much of the contracts are getting retained? This year, barring one contract, I think we've been able to retain the entirety of the clients, and we've been able to grow them as well. Reliance has grown, HDFC has grown, IDBI Bank has grown, albeit in a new state for us, which is Sikkim. So we have been able to grow them as well. And
Not IDB, IndusInd.
IndusInd, sorry, IndusInd Bank. IndusInd Bank has grown as well. So typically, what I believe is that we should be able to clock in 10 to 12% growth in terms of revenue compared to the last year. And in terms of our CCTV business, which is a which is of EPC nature, which is where we execute it's a project based business. We will be I think by Jan or Feb, we should be bidding for at least 14 to 15 crores in of projects, and we're trying to convert majority of them.
Thank you, sir. So next question is, how do you balance growth with cash flow discipline?
Okay, so I'll take that question.
Yeah.
On the cash flow side, we typically in our business, it's we invest for, let's say, 3 months in 3.5 months. Let's take 3 months for the government contract. So what happens is, at the end of the first month, we pay wages to the security guards, and then we submit the invoice. And the first month's invoice gets paid in the fourth month. Second month's invoice gets paid in the fifth month. Third month's invoice gets paid in the sixth month. And from that point onwards, until and unless we get a collection, we try to, we it becomes difficult to release wages. That ensures a certain level of discipline in terms of cash flow. And clients, and typically because we've been in the industry for 40 years, we have very marquee clients who are also very conscious that the wages should get deposited on the security guards or cleaners' accounts, bank accounts, at the beginning of the month. So they also, pay up on time as much as possible, so that there is no disturbance to the cash flow. So this is one thing. Of course, getting cash flow from the government has always been a challenge. Over the last 1 year, considering we are also an MSME, and they have expanded the definition of MSMEs to cover companies within 500 crores, we have seen that our cash flow, at least with the government, has improved slightly. Having said that, last 3 years we've been able to, at a consolidated level, and standalone level, we've had a positive cash flow, positive and a growing cash flow. And I think that this year also we will end with a positive and a growing cash flow. So that's number one on the wage front. The second part is the kind of investments that we make to acquire a contract in terms of earnest money deposits and security deposits. So there, of course, if we don't get a contract, one of the risks is that the earnest money deposit can get stuck at a government level. So over a period of time, we have now we become better and much more efficient in collecting the EMDs and the security deposits of contracts which have completed, and rolling them over into, let's say, another bid. And again, that ensures that there is no buildup of EMDs and security deposits. So that is the other part. So this way, I think we ensure that we don't choke the growth just to preserve the cash flow, but also ensure that there is a healthy revenue growth, and there is relation with the clients are maintained, and our cash flow remains positive and supports our business on a month-on-month basis. If Mr. Chaudhary wants to add something, then.
No, I think it covers it all. Basically, the essence of our business, in fact, the more and more it is happening that as we are becoming more and more organized, the essence of our business is becoming cash flow management. And because we also operate on a very thin margin almost on all fronts, and so managing the cash flow to somehow manage ensure that there is no bursts in the finance cost, etc. So we have to remain very alert to the cash flow issues, and we do that.
Thank you, sir. So we have next question from Mr. Rahil. He's asking what is the current value of tenders open in the market and what is the value for which company has bid?
I think I can take that question. So, current value of tender. So, like I said, I think by January, we are thinking we should mostly be able to bid for 14, 15 crores in terms of tenders. So, what has happened is what we have noticed, at least post October, moving into November and all, is that tenders have gotten delayed, and especially at the state government level. I'm guessing the elections would have had something to do with it, but really no way to be sure about that. So we now believe that the tenders which we were supposed to bid by, let's say, November or maybe early December, we should be able to bid for them by January, February. We have already bid for, I think, one contract in the irrigation department, which we have won, but we are yet to receive the work order of the same. Mr. Chaudhary, are you aware of the value of it?
The irrigation department contract will come to about something about, I believe, 20 lakhs per month in revenue. And there are also going to be certain tenders which are just coming about over the last 15 days or so, which could actually help us. We have increased our numbers in certain new contracts that we have taken. One example is, let's say, there is a contract that we have got from a port, Haldia Port, here in West Bengal. And there is already a discussion that if the volume of the contract will increase by participation in another tender in the same company. So we are looking at something about, say, if you look at a total annual contract, so we will be bidding over the next 3 months for at least about, as Kanad has said, 14, 15 crores of rupees in annual turnovers in the manpower segment, and similarly also in the systems segment.
Thank you, sir. So next question we have from Mr. Nikunj Patil. He's asking how sensitive are margins to wage inflation or statutory cost changes?
Well, Kanad, you would like to address that, or should I?
No, I think so. Basically, the question is how much does wage inflation and statutory cost increments impact margins?
Yeah, you see, it does. I will give you an example which would be very helping us to understand this. Over the last 15 years, if you look back, then we would see that traditionally our contracts would come with a service charge of approximately 10%, 10 to 9% of the total value of the contract, whereas the minimum wages were all less than, say, about 6,000 or 7,000 rupees per month, excepting a few central government contracts. But over the years, now what has happened is the minimum wages have all moved to beyond 10,000 or more, and the service charges have come down to less than 6% or 7% in most cases. So there is, of course, an adverse relationship between the increasing wages and reduction in the service charges. It does affect, and now effectively what is happening is with time, many organized contracts are now shifting towards a fixed value per person instead of a percentage of the wage as our service charge. So these pressures are there, and that is why it is also very important that we build in more elements of value addition in our contracts, apart from just the management of labor and payrolls.
Thank you, sir. So we have second question from Mr. Nikunj. He's asking, are escalation clauses built into contracts to protect margins?
Yeah, mostly escalation clauses are there in the contract, but all these escalation clauses usually cover the increase in the cost due to revision in the statutory wages and other statutory contributions. So there is usually no increase in the cost provision for increase in the charges for a general inflation per se. But we are usually protected against inflationary pressures on wages and other statutory contributions.
Thank you, sir. So we have next question from Mr. Rahil. He's asking, what is the steady state growth rate the company can achieve given the current market conditions? Any visions or aspirations from the company?
Well, the fact remains that we do very strongly aspire to continue to grow at a pretty brisk pace. And our original ambition had been to see that whether we can actually achieve a rate of growth to about, say, 20 odd percent year on year basis. But we are working on certain factors, like as I said, bringing in a mix in our different offerings and moving more and more towards security, surveillance, etc. So these would actually help us to actually have a growth of a higher number of growth. And if we can achieve a 20% growth or so over the year, it would be very satisfactory for us.
Thank you, sir. So we have next question from Ms. Nisha. She's asking, with the recent labor law changes, do you expect any near-term pressure on margins from higher wage or compliance cost?
Well, the new wages, the wage codes and others that have come about and are applicable has still got some ambiguities, especially on their implication in the state minimum wages and the state statutory compensations, etc. Because the wage has been declared centrally as yet, but usually the labor benefits, etc., come comes with concurrent rules being framed at the state level, which has not yet happened. There would be certain inflations in prices, but it is true that the industry of security guarding and typically housekeeping, which are very manpower intensive industries, there are no immediate solutions to reducing this manpower pressure. So we will see quite a bit of this increments being absorbed within the different contracts, both on the contractor side and also on the client side.
Thank you, sir. So due to time constraint, we will be taking more 3 to 4 questions. So we have next question from Miss Rasika. She's asking, how do you compete against price-led players without compromising profitability?
May I please have it again? How do I compete?
So,
How do we compete?
no, I
Against
think the basic,
price-led
I think the basic idea behind the question is, I'm not sure what is a price-led player,
players without
but compromising on
compromising
profitability.
profitability.
Okay,
But
I will try to answer that. I've got it. Uh, you see, there are different ways of how do we deal with the competitor who is only price conscious or offering only on the base strength of price. You see, both security and facility services, they have a very strong element of service outcomes which are measured by the customers, because ultimately if we are providing a security guard, it may be the lowest cost security guard that a client may take. But the fact remains the security guard is expected to deliver certain services which would require training of the guards, which would require a certain kind of infrastructure with the agency, and which would also require certain literacy levels of the security guards and experience. So and similarly for the cleaning agency, and one would expect that the wages, the price-led offers would only be around personnel who are unskilled in character. But typically, even a soft service like housekeeping and the hard services, of course, without exception, require a much higher skill level, and they also require support of machineries and other consumable materials, and materials not only which are cleaning agents, but it is also materials which are uh, hygiene conscious materials. So with a very tight price-led competition, we put up to our customers the benefits of having a properly priced contract where apart from the commercial ends, the value accrued from the contract is also assessed. And over the years, we have seen tremendous impact of that. It is hardly we do compete with the lowest cost competitor, even in the public sector environment. But we actually compete among competitors who are leveled around certain offerings and certain standards of offerings.
Thank you, sir. So we have next question from Ms. Arundhati Shinde. She's asking which services or client segments will drive the next phase of growth.
Technology will definitely drive the next phase of growth. I'm more or less confident about it. This is one, because as we are having more and more machineries coming in to support these services, and also more and more intelligence-driven softwares, etc., to support. So we will see a lot of growth in those areas. That is firstly. And secondly, also another area is going to become very important is providing comprehensive services instead of standalone services. What customers would always be more keen to have possibly a single agency providing the entire gamut of facility management services instead of having separate agencies as security guarding or housekeeping services or soft services or even hard electromechanical services. So these are the two drivers that we see as driving the future growth of both the security industry and the facility management industry.
Thank you, sir. So we have next question from Mr. Rahil. He is asking, does the company work on order book basis? If so, what is it? What is it as of today? How do we assess Assess the contracts or orders visibility.
I think part of it has already been responded to by Kanad. And we assess our contract tenders, offers, or order pipelines on the basis of certain credentials. Firstly, it is what is assessed is whether we do have adequate credentials for participating and bidding for certain tenders. And once we assess that, then we also try to identify that do these capabilities of ours actually remain commercially viable in the tender format. So basically, these are the two elements: the technical credentials and the commercial viability are assessed primarily in tenders.
The next question is from Mr. Murli. He's asking what is the TAM, SAM, and SOM, and what is our market share currently, and what are our projections in 2 to 3 years?
So the TAM, it's very, you see, as I said, the almost 80% of the industry is informal, and therefore it is extremely difficult to assess what is the TAM for the either of these industries, the security industry or the facility management industry. That is the first problem in identifying a clear TAM. And then, of course, that one is in our case, like the security guarding and security systems, etc. One happens to become replaceable by the other, which means that we may have a security guarding contract, which can be partially offset by a security electronic systems contract. So, which means if we are trying to compute the entire business of security, then we will come across a very complex arrangements, and so the numbers would be very high. Kanal, can you give any estimate on what could be traditional? I think I was just checking out this
I
morning
think
only,
it
and
will
I
be
was
there in the profile that you read out from, at least the TAM.
yeah. What I can say is that it is say
In the second page.
in more than 7.1 billion USD by 2030. The Indian, just a second, the Indian video surveillance market is also expanding rapidly and is projected to rise from about USD 4.4 billion in 2025 to more than USD 7.1 billion by 2030. This is one. And the organized facility management sector in India is experiencing strong momentum and is expected to grow to nearly USD 61 billion by 2030. So, but giving you a very clear TAM for today, and especially for the SAM and SOM, are also slightly difficult.
Thank you, sir. Sir, as we are running out of time, we will take one more question, and after that, we will conclude this session. So we have a last question is from Ms. Rasika. She's asking, what systems or technology platforms are used for workforce management, attendance, and compliance?
Ma'am, we use our own ERP. We have our own software for attendance monitoring. We have our own software for uploading personal details. And we also have our own software for the entire payroll management. So typically we use this for ourselves, and we have built this up our own ERP system from 2006 onwards. So we have depended on this, and we have from time to time tried to benchmark our software's performance against very established standard benchmarks which are available in the market.
Thank you, sir. So, thank you, sir. Thank you, everyone, for your time and
You're welcome,
participation.
ma'am.
If there are any further questions, you can reach out to us at corporateaccess@kirinadvisors.com. Thank you, sir.
You're welcome, ma'am. Thank you.
And thank you, everybody else.
And Sahil sir, thank you very much.
Thank you so much, sir.
Thank you, sir.